Hello friends, in this video we will study the bank finance management and the module is module B and the unit is 8th unit, that is the risk and basic risk management framework. So let's move to the actual syllabus. So friends, see in this module very first we will study what is the risk. What is the risk? That is in your CAIIB Macmillan book they have given some introduction about the risk. So what is introduction they have given? So friends, don't I suggest don't go through that introduction part. In simple words, we all know what is the risk, right? In any business there is risk, right? हर एक बिजनेस में रिस्क होता है. So friends, see here some short notes. See what is the risk in 8.1 introduction. They are saying risk is unavoidable in any business. We know हर एक बिजनेस में रिस्क आता है, राइट? रिस्क इज अनअवॉइडेबल इन एनी बिजनेस. फॉर एग्जांपल अगर हम गोल्ड की बात करें, इफ देयर इज यू टेक गोल्ड देन देयर विल बी अ मोर रिस्क. in case of grocery or other household items there will be less risk, right? So in every market, in every business there is a unavoidable risk, but it is somehow more, in some business it is less, right? तो हर एक बिजनेस में रिस्क तो होता ही है, ठीक है. अब हम देखिए रिस्क इज अ कॉम्प्लिकेटेड कंसेप्ट. रिस्क जो है वो एक कॉम्प्लिकेटेड कंसेप्ट है. दैट इज इट इज वेरी डिफिकल्ट टू क्वांटिफाई. वी कैन नॉट जज द रिस्क, राइट? सो दैट्स वाई रिस्क, स्टडिंग द रिस्क इज वेरी इंपॉर्टेंट. हमें याद रखना है कि हर एक बिजनेस में रिस्क आता है. फॉर एग्जाम्पल गोल्ड की अगर हम गोल्ड बिजनेस देखें तो रिस्क ज्यादा है. कभी उसका रेट बहुत हाई हो जाता है तो कभी लो भी हो जाता है. हम प्रेडिक्ट नहीं कर सकते, राइट? तो ग्रोसरी का भी वही है, उसमें लेकिन रिस्क क्या है? कम है ग्रोसरी की मार्केट में. तो इस प्रकार से रिस्क जो है वो हर बिजनेस में है लेकिन वो अनअवॉइडेबल है, राइट? और हमने जो कहा कि रिस्क जो है वो कॉम्प्लिकेटेड कंसेप्ट है, हम एक्चुअली इसे कैलकुलेट नहीं कर सकते, राइट? और हमारा जो अजम्पशन है वो हर एक बार सही आएगा या नहीं, राइट? इसीलिए कहते हैं कि रिस्क इट इज ए कॉम्प्लिकेटेड कंसेप्ट. सो फ्रेंड्स, सी सम डेफिनेशंस. See in your Macmillan book what they have given. We may define risk. What is risk? It is uncertainties resulting in adverse outcome. It is uncertainty resulting in adverse outcome, adverse in relation to planned objective or expectations, right? Risk is nothing but the uncertainty resulting in adverse outcome, right? And what is they are saying? Financial risk, it is the uncertainty resulting in adverse variation of the profitability or outright losses. See friends, they have given some in complicated words. What is the risk? See some definition of the risk. Basic definition: risk is nothing but the probability of uncertain events. What is risk? जैसे हम कहते हैं कि रिस्क है, मतलब what? Risk is nothing but the probability of uncertain events, right? What is risk? Risk is also called as the probability of the extreme hazard, that is extreme loss. हमें कहीं ना कहीं बिजनेस में लॉस होने की संभावना, that is nothing but your probability of extreme hazard, that is probability of extreme losses, that is also called as the risk. See in finance risk indicates variation in profit or loss. Risk indicates variation in profit or loss. If you take more risk, if that may lead to a loss or that may lead to a profit, that means risk indicates the variation in the profit or loss considering the adverse situation, right? So in other words they are saying financial risk are uncertainties resulting in adverse variation of the profitability or outright losses. मतलब फिनेंशियल रिस्क में क्या होगा कि हमारा जो प्रॉफिट है वो घट जाएगा और हमें ज्यादा लॉस होगा. इसे हम कहेंगे फिनेंशियल रिस्क, राइट? तो आगे देखते हैं. फिनेंशियल रिस्क हमारा हो गया. तो ये जो दिया हुआ है इन्होंने, ये बेसिक कंसेप्ट आपका क्लियर होने के लिए है, लेकिन एग्जाम पॉइंट ऑफ व्यू से यहाँ से कोई भी क्वेश्चन नहीं बनेगा. दैट इज नॉट इम्पॉर्टेंट. सो आई सजेस्ट यू कैन स्किप दैट पार्ट. डोंट गो थ्रू दैट. You can just read the next what they are saying about the risk. See friends, uncertainties associated with risk elements impact the net cash flow, very important, of any business or investment. under the impact of uncertainty, variation in net cash flow take place. The possibility of unfavorable impact is the risk of the business. See friends, what they are trying to say, see here. Very first, we will see what is difference between the risk and uncertainty. They have the word they have given here is uncertainty. See what is the difference between the risk and the uncertainty. See friends, uncertainty means what? It is no fixed or certain outcome. If there is not a fixed outcome, we can say it is an uncertainty. For example, there is a 50% chance that gold rate go double in 5 years. That is nothing but the uncertainty about the gold rate, right? Whereas what is a risk? What is a risk? Risk is the state of uncertainty. Risk is the state of uncertainty that lead to bad outcome. That means risk is more danger than the uncertainty because it leads to the bad outcome, that is the loss, right? So there is difference between risk and uncertainty. What is example of the risk? See friends, here there is a 20% chance that loan will become a NPA. That therefore 10 crore loss to the bank. That means in this we are directly getting the loss to the bank. So that is nothing but the risk, right? So there is difference between risk and uncertainty. So you might be clear about what is the risk and what is uncertainty. They have given in other words, very high words in Macmillan book. What is difference between risk and the uncertainty? Next, see friends, what they are trying to say here. See friends, let's elaborate here in short note. See friends, when there is lower risk, lower cash flow will be there. Lower cash flow will be there, right? That means your downside potential will be changes low. What is downside potential? We will see in see friends. If there is more cash flow, if there are more transaction in the business, that means there will be more risk, right? If there are more transaction in the business, the risk will be more. If there are less transaction in the business, there will be less risk, right? Simple, right? If there you can remember, if there is more cash flow, that therefore risk will be more. The risk will be more. Less cash flow, therefore risk will be less. So if the cash flow is more, we can say there are chances of the profit going high और सडन गोइंग लो, राइट. ऐसा हो सकता है कि ज्यादा कैश फ्लो है तो कभी कभी प्रॉफिट बढ़ेगा तो कभी कभी घटेगा. जो बढ़ने की जो दिस इज लाइन दैट इज कॉल्ड एज अपसाइड पोटेंशियल, मतलब देयर इज पोटेंशियल टू इंक्रीज, दैट इज अपसाइड पोटेंशियल, एंड दिस इज द डाउनसाइड पोटेंशियल, मीन द एबिलिटी टू डिक्रीज और कैपेसिटी टू डिक्रीज, दैट इज नथिंग बट योर downside potential. This is your upside potential. So friends, what they are saying, see friends, in lower risk, what is lower risk? That means lower cash flow. I have already told. That means lower downside potential. That means lower downside potential. More cash flow, more risk, more upside potential. In less cash flow, risk will be less. So downside potential will be less. So you come to know what is the downside potential, what is the cash flow, right? See friends, they are saying, what they are saying, variation in a net cash flow is lower. If variation in net cash flow is lower, it will result in the low profit and low losses because there is a low cash flow, right? If there is more cash flow, more risk, and that means we can assume more profit. See friends, lower risk implies lower variation in the net cash flow, lower upside downside potential. Higher risk would imply higher upside and downside potential. So how can we see one example is there in RD or FD. If you make RD or FD, there is a very less cash flow, right? You can deposit one times or you can deposit monthly, right? So there will be less cash flow, right? So there will be less risk in the RD and FD, right? So there will be less risk because less cash flow. Whereas if you invest in mutual fund, If you invest in some company, then that company again invest somewhere else. That means more cash flow, right? If there is more cash flow, then there will be more risk. That means we always hear in the advertisement, mutual funds are subject to risk. Why? Because there are more cash flow, and whereas in RD and FD there are less cash flow, so therefore risk is less. So you come to know what is relation between the risk and your cash flow. Simply there is a direct relation. You can easily remember, there is a direct relation between the cash flow and the risk. IIBF may ask one liner MCQ. The relation between the cash flow and the risk is direct, indirect, inverse. So you have to remember this direct relation. Means if your cash flow is increases, your risk will be increases, right? If your cash flow is decreases, your risk will be decreases, right? If cash flow increases, means your chances of upside potential will also increase, and chances of downside potential will also increase. See, in share market there is no chance that there is no fix, right? No fixed value. Sometimes the share value may go up, sometimes may go down. That is upside potential, there is downside potential. Upside potential means price going high, and downside potential means price going low. That is less return. Here are more return. So friends, you come to know what is the direct relation between the cash flow and the risk, right? So we'll move to the next point. So here they are saying zero risk. What is zero risk? We have here we have seen the more risk and less risk. But what is a zero risk? We have seen cash flow is more, then risk is more. Cash flow is less, then risk is less. If there is a zero cash flow, then we can say there is no risk at all, right? We can say, right? So in zero cash flow there is no risk. There is a MCQ, there is chances of MCQ, right? Zero cash flow, no risk. So okay, we will move to the next. See friends, in 8.2, see in short note, see what is the we have already seen the relation between the lower risk is the lower cash flow, higher risk is the more cash flow. If zero risk, if we say it is zero risk, that means we can predict 100% of the future cash flow, right? How? See friends, for example is RD. In RD what we are doing, we know how the cash is flowing. That means in every month you are depositing some value, some money, some cash, right? So that's why we know 100% prediction of the future cash flow. Very, very important. For zero risk, we can say zero risk, we can predict 100% future cash flow. This is very, very important for your MCQ point of view, right? For zero risk, there will be 100% prediction of the future cash flow. Now, here what they are saying, return on zero investment would be low. That is zero risk, that we have already studied. So friends, see here, what is the next? We have to study the 8.2, that is the linkage among the risk, capital and return. What are the relation between the risk, capital and return? So see friends, I have already explained you the relation between the risk and the cash flow. It is somehow similar, that is relation between the risk, capital and return. So friends, just imagine, if risk is more, then there is chances of getting loss is more, so you need more capital, right? So we can say if risk is more, then capital requirement is more, and return expectations is also more. If you are investing more, you can expect a return more. Return expectations are more. So see here, wide variation in the net cash flow with a high risk, that I have already explained, right? More cash flow, more risk. Next, what they are saying, capital requirement would be higher because of possibilities of the higher losses, right? If risk is more, the chances of loss is more, right? Therefore you need more capital, right? So if a capital requirement would be higher if there is chances of losses due to the high risk. So in reverse condition, with a lower variation in the net cash flow. With a lower variation in the net cash flow, there will be low risk. So there will be chances of less losses. We can say profit potential is more, right? So therefore, due to low variability of net cash flow, there is chances of less losses, right? So capital requirement would be also lower because of less cash flow. So we can say, remember, you can easily remember here, there is a direct relation between risk, capital and return. There is a direct relation. You can remember directly. You can remember there is a direct relation, means risk increases, capital increases, losses increases, return expectations also increases, right? There is a direct relationship. So no need to read all that. Just remember the relationship between risk, capital and return. All the relationship is direct. Very important. So now see here. In short note, in short note, you can easily come to know what they are trying to say. See, what is the relation? 8.2 is the relation, that is linkages between the risk, capital and the return. See friends, risk estimation. What is risk estimation? Risk estimation is nothing but to calculate the probable losses. To calculate the probable losses. How risk is estimated? It is used to calculate the probable losses, how much loss we can occur in our business. That is why risk estimation is needed. To allocate some capital, right? So that is why risk estimation is needed. To set a price of the product, there is final product price. After the losses, we have to set new price. That's why risk estimation is needed. So you can see in terms of banking example, you can easily understand. See friends, to calculate probable losses, we have always categorized in loans in the advances in the NPA category, right? So why we are categorizing? To calculate the probable losses. So there is direct linkage. In banking, we are doing NPA categories, right? Why? To calculate the probable losses. Next, to allocate capital, right? See, government is always infusing capital in the public sector banks. Why? Because there are losses. So to run the business, they need a capital. So to calculate the capital, government infuses the capital. That's why you are directly linking with the banking, right? Next is to set the price of the product. After getting loss, you have to set new interest rates, right? So you can compare like loss making banks like a Bank of Maharashtra or UCO Bank. They are loss making banks. So their rate of interest for the loans will be more, because they are loss making, right? So in this type, that's why risk estimation is very, very important, right friends? See the basic relationship. Already I have explained you the basic relationship between the risk, capital and return. Again we will see in the short video, in the short notes. See friends, what is the relation between the risk, capital and the return? See friends, net cash flow. If your net cash flow is more, your risk will be more. That's why the chances of getting loss will be more. I have already explained that is the direct relationship, right? So if risk is more, then capital, that loss is occurred, then you need more capital, right, to run the business. That's why capital will be more needed. Net. If your cash flow is less, then your risk will be less, and that's why your capital requirement will be less. So there are chances of less loss making, right? So in very first example, if there are cash flow is more, risk is more, capital requirement will be more, losses will be more, but due to the more cash flow, there is a expectation, that is the return expectation is very high. Very important. Return expectations are also very high. But if the cash flow is less, in that case return expectations are low, right? In the beginning, since beginning I am explaining you more cash flow, more capital, more losses, but return expectations is more, like a mutual fund. Okay friends, now we move to the next. See here some important point. Minimum capital that businesses require, the minimum capital that business require should be able to cover maximum losses to avoid the bankruptcy. This statement you have to mug up, because this is very, very important. Because minimum capital required to any run business should be able to cover the maximum losses. to avoid the bankruptcy. That's why the government is infusing always the capital in the public sector banks. Okay friends. Okay, next, for example, take example here. Take example of personal loan, right? In personal loan, we all know rate of interest is very high, right? Why? Because there is no security, right? No security, no mortgage, so risk will be high. If risk is high, then your rate of interest will be high. So there they may ask you a one-liner question like, if risk is high, then your rate of interest will be high. Very important. Next, whereas in case of FD and RD, rate of interest is low. Why? Why we are paying less interest in the FD and RD? Because there is very less risk in that. Where less risk, right? In mutual funds, you will get more return, but there is more risk, right? So this is the relation you have to remember. So friends, now we will move to the next topic. So what is the next topic here? See friends, next topic here is the return on asset, RAROC. So I have already explained you. They are what they are saying. Higher the risk is, the higher would be the premium. That is not any hard. That is the common sense we can remember. We can have. If there is more risk, there is more premium. You can remember easily from your insurance. If in insurance your risk is more, then premium will be more, right? It is common sense. But sometimes it is said that common sense is not that much of common. Okay, we will move to the next. See, remember, you have to read only the highlighted parts, because there is no chance of framing the question from the non-highlighted parts. Just read the highlighted parts. Risk in the business or investment is netted against the return from it. This is called risk adjusted return on investment, right? We all know what is a return on investment, but risk adjusted. But the risk adjusted return on investment is nothing but the netted against the return. So what is netted against the return and all? See, the higher the RAROC, higher is the reward to investment or shareholders. That means RAROC is more, return will be more, right? So they will prefer more investment, right? So next, what they are saying, the higher is the risk in the business model, higher would be the capital requirement and the return expectations, that we have already learned. So basic, what is RAROC, you can see and learn from the short notes. So friends, see here, what is RAROC concept? What is the RAROC concept? We will learn in detail in short notes. See, if so what investors are demanding? Investor demand more return. So that's why they are buying the shares of any company or bank. Why? They want more return. For example, say Rakesh Jhunjhunwala, he want more return. That's why he is investing in your bank for buying shares, for investing in a higher risk opportunity. Why he is demanding more return? Because he is investing in the risky environment, that is risky opportunity. There is risk in the share market. You cannot guarantee say that you will get that much of return, right? So that's why he is investing in the risky environment. That's why his expectations about the return is high. Now suppose Rakesh Jhunjhunwala invest in the ICICI Bank. Suppose he invest in the ICICI Bank rather than SBI. Why he prefer to ICICI? Because he is expecting the more return. He will not invest in ICICI. He will not invest in Bank of Maharashtra. Why? Because he want more return. So when there is more return, there is risk is more. Why? We have already learned in the previously, risk is directly proportional, we can say, to return expectations. If there is more risk, the return expectations will be more and there will be more capital requirement. So that's why it is direct relationship. So this additional expected return, very important, additional expected return. We know all we will get return in SBI or Bank of Maharashtra, but in ICICI he is expecting more return because of the more risky environment. This additional expected return is called as the risk premium. This is called as the risk premium, or it is also called as the cost of the risk. Right? You come to know what is the risk premium and what is the cost of the risk. Now, see friends, returns net, that is net returns of risk premium. Returns net of the risk premium are called as the risk adjusted return on the capital, that is the RAROC. Right, you come to know what is risk premium and you come to know what is the risk adjusted return on the capital, RAROC. Okay, it is very important for managing the business. To manage the business, RAROC factor is very important. Okay friends, see here MCQ part, how MCQ can be framed from RAROC. See friends, if RAROC is more than a risk premium, then outcome will be positive. That means your share price will increase and you will get profit. That is, outcome will be positive. If RAROC is less than the risk premium, then your outcome will be negative. That means there are chances of getting downside potential. So there will be losses. If RAROC is equal to the risk premium, then outcome will be neutral. Right? There will be no gain, no loss. Remember that 3 lines that can frame a question in your examination, one-liner MCQ. So now we will move to the next. What they are saying in the book. See, why risk needed to be managed. रिस्क को क्यों मैनेज करना है? Why we need to manage the risk? Why risk is supposed to manage? So friends, you can read this and what you learn, that I will explain in the very short note. So don't read that. It is common sense that we need to manage the risk to avoid the losses and to gain more, right? So in short, see friends, here are some short notes made for you, only for you. See why risk is need to be managed in risk management. See, if risk is more, deterioration of the capital. If risk is more, if you involve in the more risky environment, if you invest your all money in the mutual fund, you can lose your all money, right? There is no guarantee, right? So if risk is more, deterioration in the capital will be more, so we can lead to the bankruptcy. In other hand, if risk is not taken, we can lose opportunity in the market, right? If there is chances of invest in the gold and the gold rate is going high and it will touch 1 lakh rupees for 10 gram, then we can lose the opportunity. Whereas there is no guarantee that it will touch to 1 lakh rupees for 10 gram gold rate. So there is both chances. We can lose the opportunity as well as we can lose the capital also. So that is very important. That's why it is important to study the risk management. So friends, from that, instead of reading this, I have explained with the example of gold why risk is important to avoid the capital loss, and to also avoid the opportunity loss. That for that 2 important reasons we are studying the risk, why risk to be managed. See friends, here another some important part, risk management. What is risk management involved? What is basically a risk in risk management? When you read this all, you will come to know only the things that I have made for you a short note. After reading this, you will come to know that only important part is this. What is risk management? How risk is managed? Very first, it is you have to identify the risk. Very first, you have to identify and measure the risk. Secondly, you have to estimate the cost of controlling them. And thirdly, you have to control and mitigate the risk. And fourthly, revise risk management strategy based on your experiences. So basic, there are steps. You don't need to remember all steps, but just read, so you come to know how risk should be managed. So after reading this, we have to read some important MCQs. So before going for the MCQ, very important part here is the summary. Very important part is the summary. See friends, what we have learned is risk is an uncertainty resulting in the adverse outcome that we have studied. What is the financial risk? Uncertainty resulting in the adverse profitability. When there is profit or loss is involved, we can say is financial risk. Financial risk means that uncertainty lead to loss. Simple. Next, risk element impact the net cash flow, that we have that we also studied. More cash flow, more risk. Less cash flow, less risk. Okay, now we will move to the next. See friends, here what they are saying here in the next summary part. See, lower risk implies lower variation in net cash flow, right? We have studied, right? Risk is low when cash flow is less. That means lower upside and lower downside potential. That if risk is less, cash flow is less, then we cannot expect a sudden increase or sudden decrease. That is upside potential and downside potential we cannot expect. So if risk is low, cash flow is low, we can expect steady condition, right? Next, higher risk means higher upside and higher downside potential. If risk is more, then cash flow will be more, and higher increase or decrease, that is higher upside potential and higher downside potential. The chances of up or down in the more risk and more cash flow. Next, zero risk means what? No variation in the net cash flow, right? Okay, we have studied. Return on zero risk investment would be low as compared to the other opportunity available in the market, definitely. Next, capital requirement of the business, very important. Capital requirement of the business revenue model depend upon the risk associated with the business, okay, and expected return on the investment would be the factor in risk associated with. That means what we have studied is, they are saying the relationship between the risk capital and the what? Risk capital. What we have studied, risk capital, relationship between the risk capital and the return. Risk is more, capital requirement is more, and return expectations will be more. Risk is less, capital will be less, and return expectations will be direct relationship, right? That is the nothing but they have given here. Next, controlling the level of risk in an organization is nothing but the identification of the risk, measuring of the risk, controlling, mitigation of the risk, and the estimation cost of the risk. That step I have already explained to you in the brief. Now what we have learned, based on this we have to check the progress from the Macmillan book. See, very important is first question, investment in a post office time deposit is, we know all post office is nothing but the zero risk, right? Because it is government, so there is very less cash flow, there is steady cash flow, that's why zero risk investment. Next, zero risk investment implies, what is zero risk investment? That means zero variation in the cash flow, right? Zero variation in the cash flow, simple. Next, which of the following statement is correct? See, higher the risk, higher will be the risk premium. I have already told you in the common sense, risk is high, premium will be high, direct relationship. Next, which of the following statement is correct? See friends, very first is the higher the risk in the business, higher would be the capital requirement. Risk is more, capital requirement will be more, direct relationship, it is correct. Higher the risk in the business,